sometimes you're late to the story. And all you can do is try not to chase. But just because we missed a miraculous move, that doesn't mean we shouldn't try to understand, learn from it, and put it in context. For weeks now, I've been watching the incredible run the two big coffee chains have had, Starbucks and Dunkin brands. The former up nearly 29%. This is a big cap name. The latter up 25%. And these companies have done a fantastic job of defying the bears. Starbucks is supposed to be caught in the crosshairs of the trade war with China. Dunkin was being targeted by some legendary short sellers predicting a downturn. In the end, both stocks have caught fire, and while I think they're too expensive for the moment to pounce on, it's worth thinking about what's fueling this move. See, it's not just about coffee prices, which have indeed been trending lower for the past couple of years, and it's helped gross margins. These are two companies that have taken control of their own destiny. So why don't we first start with Starbucks, okay? Now, this is my favorite of the two, candidly. This is a stock that spent years lost in the wilderness, bounced between the 50s and 60s, 50s and 60s. Now it's at 83. What happened? Okay, about a year ago, the stock had a big breakdown when the company pre-announced some ugly numbers for the third quarter. And you can see, I mean, this thing is kind of mark time, okay? Management slashed their same-store sales forecast from 3% down to 1%. Boy, the market hated that. They trimmed earnings guidance. CEO Kevin Johnson, late of Juniper, who was on the board of Starbucks, and replaced Howard Schultz. I know he's irreplaceable, but he replaced him. Came out and admitted that our recent performance does not reflect the potential of our exceptional brand and is not acceptable. Boy, you gotta love it when executives admit fault and then take responsibility for not delivering. The stock briefly dipped to low as 47 on the news, but since then, Starbucks has been working its way higher, practically in a straight line with only a couple of speed bumps. And how did they do it? Well, this is a learning lesson. At the same time Johnson took responsibility for the disappointing results, he told us what he planned to do to fix it. The plan. Johnson said Starbucks would close more underperforming stores in most densely penetrated markets. He talked about new digital initiatives to bring in more customers, and he promised to return $25 billion with a B in cash to shareholders via dividends and buybacks, including an immediate 20% dividend boost. However, in the wake of that negative pre-announcement, the analysts turned on Starbucks. The U.S. business seemed to be slowing. The Chinese business was flat. It didn't inspire a lot of confidence. Of course, we brought Kevin Johnson on the show the very next day, and we asked him some very tough questions. He told a very good story. But it was tough to like this one at 48. In retrospect, that was the perfect time to buy. Now, your next opportunity came 6 months later, when Starbucks held its biennial investor day in December. While there was a lot of new information coming out of the event, everyone focused on the unfortunate headline that Starbucks had cut its long-term earnings growth forecast from 12% to 10% in a very tough moment for the market. That's not what anyone wanted to hear. The next morning, I sat down with Kevin Johnson and Dara Khosrowshahi, who are the CEO of Uber, because the two companies were partnering up on delivery. My first question was about the guidance, and Johnson pointed out that his forecast for the next few years remains strong. The 2019 guidance was unchanged for 2020 and 2021. He called for 13% earnings growth. It's only after 2021 that he had Starbucks trimmed its long-term forecast out of an abundance of caution. But the market wasn't having it, and the stock got dinged on the news, falling to 60. Once again, that was a great buying opportunity. And to be fair, when they started buying stock back in the low 50s, I was on board. But then I really just felt like, well, wait a second. This could be foul money. Why? Because Kevin Johnson, I've known him for 20 years, and he's a man of his word. Between his digital initiatives, his execution improvements, the partnership with Uber Eats, and his buyback, Starbucks has been able to deliver two excellent quarters in a row. Remember that $25 billion the company told us it would return to shareholders? As of March, they've already gone through $14 billion, and they bought a ton back in the low 50s. And they announced another $2 billion accelerated buyback on top. Remember, they got all that money from Nestle's. This man, I mean, I've known something. There's an advantage to being around for a long time. I knew how great this guy was at Juniper. I knew he was money. Then last month, the stock experienced one last pullback from 80 to 75. As the China fears heated up, Starbucks is the largest coffee chain in the People's Republic, which is a major source of growth for the company. People are starting to talk about how Luckin, which just came public, is going to hurt them. But the stock has shrugged off those worries. And the Chinese consumers, they keep coming back regardless of the trade war. I think Starbucks should never have sold off so hard in the first place last year, which is one reason why the stock has had such a fabulous winter, as management just keeps delivering and delivering. Wow, the numbers in 2019 so far so good. Kevin Johnson deserved the benefit of the doubt. I'm glad we gave it to him. And while I'm hesitant to pound the table all the way up here, maybe more on that later, I absolutely think it's worth putting this one on your shopping list. Maybe on the hope that we get another pullback, perhaps because the trade deal breaks down, right? All this trade talk, we could get an opportunity here. All right, only the weakest, please. How about Dunkin' Brands, the parent of Dunkin' Donuts? Let me go over here. This one's a little different. Dunkin' stock has been moving up steadily for years, as this is a terrific regional going to national story. There used to be a lot of these in California. See, not that long ago, Dunkin' was mostly a northeastern brand with some exposure to the southeast and to the Midwest. Now it's a nationwide brand. They've also been expanding what they sell, going from coffee and donuts to more of a full-service breakfast outfit. However, last year the company drew the attention of some high-profile skeptics. And take a look at this, because this is what some short sellers can do to your stock too. Not that the stock wouldn't be headed this way, but they act as an accelerant on the downside. Roughly 14 months ago, James Chanos, he's a legendary short seller, I've known him for years, announced that he'd been shorting Dunkin' for about a year. His reasoning: Chanos said the stock was overvalued and also called into question the company's asset-light, franchise-based business model. While the company reported a solid beat and raised quarter in October, the stock sold off hard, along with the rest of the market, in November and December, okay? But then it came roaring right back. And so far this year, Dunkin's has surged higher and higher based on a series of very good numbers. How'd they do it? A lot of this is simply good, solid execution. The company has simplified its menu, improved the loyalty program dramatically, by the way, got much more technologically involved, opened new stores, renovated existing stores, and unleashed an on-the-go ordering system. When Dunkin' reported its latest quarter in May, those initiatives paid off as the company delivered a nice top and bottom line beat with better than expected same-store sales. Long story short, management made a bunch of investments in the business last year, and now they're reaping the rewards. I think the story still has legs. Dunkin' still has a ton of room to grow on the West Coast. My sympathies to James Chanos, and then, the short sellers, these guys delivered. Executives can be smart. The one problem with Starbucks and Dunkin', well, it's the same reason why I'm talking about them. The stocks have exploded higher this year, and we hate chasing stocks after big runs. Starbucks now sells for 27 times next year's earnings estimates. Dunkin' sells for 25 times these numbers. That is expensive. Worse, they've just broken out to new highs just in the past month, and that's simply not when you're supposed to buy them. But I do feel good. I told you in the 50s to buy this one, and in the 60s to buy this one, and in the 70s, so I don't have any remorse. Bottom line, sometimes you need to be disciplined. Starbucks and Dunkin' Brands are two terrific coffee chains, but if you don't own them already, I think this may not be the correct moment to start building a position. However, they're still fantastic companies, so I recommend putting them on your shopping list. If either stock gets brought down for whatever reason, because of the G20 goes bad, because Powell, let's see what he says, Powell says the thing that Trump doesn't want him to see, well, let's just say that's when you're going to get your opportunity, and you have my blessing to start buying. I'm going to Kyle in Maryland. Kyle!
A big old Baltimore booyah for you, Professor Cramer.
There's nothing like a Maryland call. I always have to say that. They have the most spirit of any state. Try beating them. Let's go to work.
Well, thank you. I'm a college student, I'm an active investor, and I never miss a show. I even take notes because I think your opinion and experience is extremely valuable.
Just a sec. I have to stop you. Kyle, can I stop conversation? I thought college kids don't watch TV. I thought they cut the cord. I thought they don't watch business. You are telling me you are a devotee and you are cadre for Mad Money, aren't you?
Professor Cramer, I even bought cable television just so I could watch your show live and not have to pay money.
Let's go to work.
All right, so my question for you today is about Luckin Coffee, ticker LK. I remember your segment on their IPO about a month ago, and I agree with you when you warned us about their cash flow statement. It's awful. But with ridiculous and rapid revenue and store growth, could you make a case for maybe wanting to trade, not invest, but trade this stock? And if not, could you give us a company who chooses this extreme growth as their business model? And where on their financial reports you see an indication of some real value or potential? Because I would argue that any company who takes on this business model doesn't have the cash flows that we get excited reading about.
Kyle, listen to me and listen good, okay? Because I'm only going to say it once. You want to go into that Luckin, that's fine. I think you're going to be eviscerated by Starbucks. What you need is Shopify. I am not kidding. I think Shopify is the greatest growth profile of any company I know. Secondarily, it would be Twilio. But I think if you buy that Luckin, you are playing with fire. And I am not going to get involved, even as I think you are terrific. And I thank you for calling. I give you Shopify. And then, secondarily, Twilio. All right, discipline trumps conviction, people. Starbucks and Dunkin brands, they're terrific. They are. They're great. We love them, right? Especially Kevin Johnson, KJ, as I like to call him. But this isn't necessarily the right moment to buy. The earlier moments when we're pounding the table were. Hey, mad money ahead. Can Lululemon or Under Armour work up a sweat in this market? Haha. I am tackling the technicals to find out. Then what Facebook's move into e-commerce really means for the stock, not like what you heard all day. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.